give a tax law update, and this is timely because it affects everybody individually. It impacts businesses, the businesses that you all deal with, and as well, this bill, when it was passed, the Congressional Budget Office upped the estimate for the deficit from $1 trillion to $1.5 trillion. There are a lot of tax breaks, extended tax cuts. We're going to talk about those, some planning ideas. This impacts everyone as well in that now Congress is talking about how to reduce some of those benefits, and those cuts certainly can impact GRADD and the individuals and businesses here. So we're going to talk about all those things. I'm going to cover the individual provisions. Edna is going to talk about the business provisions. You know, on individuals, probably the biggest area of contention, well, really when the presidential election occurred and then on into this last election when the Republicans took the House, was the extension of the Bush tax cuts. There was a lot of emphasis on the wealthy and the cuts for the wealthy, but these tax cuts impact everybody. And in fact, even the lowest tax brackets, and these are all in the materials that you have, the lowest tax bracket would have gone up 50%. So instead of being taxed at 10%, that lowest bracket would have been 15%. And the highest bracket, instead of 35%, would have been 39.6%. These were extended for a 2-year period. So we have, the way the law stands now, at least 2 years of these extended lower tax rates. The other thing that the law extended was the favored tax treatment of capital gains and dividends. Capital gains are taxed at 15%. That was scheduled to go to 20% if this law hadn't passed. And dividends, now taxed at 15%, were scheduled to be taxed as just ordinary income. So some significant favorable treatment for stocks. In fact, when you look at what the stock market did when this bill started being discussed, was the beginning of December, right after the Congress got back and talking about the effects of the election, is the stock market has gone up 7% since this bill. Basically, it became pretty much known that these tax cuts were going to be extended. So what happened is that the stock market, because of capital gains and dividends still receiving favorable treatment, it went up. The municipal bond market actually tanked during this time, because when that top tax bracket doesn't go up, municipal bonds don't receive as favorable a treatment. So it had a big impact on the market. Of course, the flip side of that is when these rates, after 2 years, if they go back to the old rates or they raise some of the favorable tax rates that are there, the opposite may occur. You may see the reverse. The stock market goes down and municipal bonds become much more attractive.
There are quite a few business provisions in the law as well, and you'll see a thrust in this of trying to stimulate the economy as we go. Probably the one that received the most publicity was the Section 179 expense, and that's where you can elect to write off costs of equipment and furniture in the initial year of purchase rather than having to depreciate them over time. That was increased to $500,000 per year in an effort to get businesses out there building infrastructure and stimulating the economy and helping with manufacturing. There are some phase outs that apply, but they don't kick in until you place and service $2 million of equipment, so it's pretty limited. The other thing that's interesting is they have 3 classes of assets. Normally, Section 179 only applied to tangible property, things you could move, not to real estate improvements. But if you have qualified leasehold improvements where there's project be subject to a lease and you do some structural work, restaurant property and retail property, you can now elect the Section 179 expense to write that off in the initial year, which is great because usually for commercial property you're talking about a 27.5-year write-off. So really a good time for people to look at making these improvements. They also enacted bonus depreciation, and this kind of goes to show how the tax law is constantly evolving. We can't get anything to sit still long enough to really work with it. Bonus depreciation allows you to write off half the cost in the first year. So if you didn't qualify for Section 179 because of the $2 million limit or because you can't create a loss with Section 179, you can look to bonus depreciation. It was 50% up through September 8th, then they raised it to 100%. So depending on when you put that property in service, you have some bonus depreciation issues. The real interesting part of this deals with automobiles. For most of you all, you know that when you have a business car, there are some pretty stringent limits on how much you can write off a year of a business automobile. If you have a heavy SUV, more than 6,000 pounds, or a truck with a very long bed, you can get away from some of those depreciation limits, but there's still a limit on that Section 179 expense of $25,000. So if I have a $50,000 car and I take the ones, and it's an Expedition or something large, I can take off $25,000 of Section 179, then write off the rest over time. Bonus depreciation doesn't have those limits. So now theoretically, if I had bought a $50,000 car and it was heavy enough, I could write off the whole $50,000 in year one. So a nice bonus for Detroit there. Bonus depreciation is all property that is under 20 years of useful life, which covers all your movable equipment and also certain things, land improvements like parking lots and sidewalks. Has to be new property, has to be original use with the taxpayer. The Section 179 can be new or used property. They also extended 15-year depreciation for those same classes of property we talked about in Section 179. So a lot of breaks there to give really fast write-offs so that people will go out and spend money in their businesses. Also part of healthcare reform started the beginnings of employer-provided health insurance. And you'll see right now we've got the carrot. Eventually we're going to see the stick on this one. But what they did was they put in a credit for small employers who provide health insurance to their employees. If they pay 50% and they're small enough, which is under 25 full-time employees excluding owners, and their average wage is under $50,000 per employee, then they can get a credit of up to 35% of the health insurance premiums that they paid. It's 25% for nonprofits. So it only applies to very small businesses, but it can be a very meaningful credit for a small business.